Jubilant FoodWorks Q4 FY26 earnings print presents a set of headline numbers that generate two divergent signals for institutional analysts. On one side of the ledger, like-for-like sales growth shows a distinct sequential deceleration. This chart shows the sequential trajectory of that like-for-like growth. In Q3, the rate side at 9. This strategy is built on three pillars: fixed cost leverage, physical store re-engineering, and micro-operational efficiency. Reconciling this P&L contradiction is the key to determining JFL's long-term unit economics and future cash flows. The LFL deceleration is composed of two divergent subsegments. As management explains in the transcript, delivery remains structurally strong. The primary drags on the headline number are the dine-in and takeaway channels. To counter this, management utilized a specific strategic lever, compressing the top line by lowering the minimum order value. The company shifted the entry price floor, dropping the minimum order value from 149 rupees down to 99 rupees. Lowering that threshold results in a sharp mathematical drop in average order value. Management accepted this AOV compression to prioritize long-term customer acquisition in a saturated market. The justification for this risk lies in the company's cost structure. More than 50% of JFL's costs are strictly fixed. In a model where half the costs are fixed, sheer volume becomes the primary driver of long-term margins. Securing a competitor's customer at a 99 rupee entry point creates the volume required for outsized operating leverage tomorrow. How does the company maintain its rapid expansion pace while order values are compressed? Guidance confirms they are on track to add between 230 and 250 new restaurants this fiscal year. This density is being financed through a fundamental re-engineering of the physical store model. Legacy store formats typically required 1,500 to 1,600 square feet. The new model focuses on compact 600 to 700 square foot nodes, specifically optimized for delivery and carryout in large metros. Kitchens are being remodeled to fit this smaller footprint, removing excess seating to maximize throughput. This physical compression leads to a significant reduction in per-store capital expenditures. By shrinking the footprint, Jubilant FoodWorks has achieved a 20% reduction in CapEx per store, sustained for 3 consecutive years. Lowering the physical footprint reduces the profitability barrier for each new unit, protecting the return on invested capital despite the lower minimum order value. This margin bridge shows the impact of severe external inflation during the quarter. The largest shock was a 100 to 120 basis point hit from rising energy costs like LPG. This was compounded by wage inflation following minimum wage hikes and new labor codes. Because Jubilant FoodWorks has a 76% delivery share, these labor costs have a larger impact than the standard 30 basis point estimates. JFL utilized specific operational offsets to climb back to a 75.5% gross margin. The first offset was a material reduction in internal food wastage. The second was an improvement in product mix following the launch of premium tiers like sourdough and Big Pizza. Finally, the company used surgically calibrated price increases on specific products, like the Volcano Pizza, rather than broad menu hikes. These micro-operational adjustments allowed the company to neutralize the macro-environmental pressure. The Q4 strategy involves absorbing near-term margin pressure on order values while aggressively optimizing operations to counter inflation. CapEx reductions and wastage optimizations have created a financial buffer on the balance sheet. This buffer is what allows JFL to fund the 99 rupee customer acquisition strategy without compromising the overall business. Market share gain during inflationary cycles is often the most durable once the macro environment normalizes. While the 6% deceleration in like-for-like sales is a temporary sector-wide trend, it is not the primary signal in this print. The defensible signal is the 75.5% gross margin. By lowering entry barriers for consumers and optimizing unit costs, Jubilant FoodWorks is positioning itself for significant operating leverage when macro headwinds normalize. Jubilant FoodWorks Q4 FY26 earnings.